Welcome to RBC's Markets in Motion podcast, recorded June 23, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, solid earnings stats are in place as U.S. equity investors wait for the onset of 2Q reporting season. Second, the latest Business Roundtable survey highlighted weaker corporate vibes relative to March, echoing the tepid tone in last week's earnings calls. And third, we recap our views on how we're thinking about recent developments in the Middle East from a U.S. equity market perspective. If you'd like to hear more, here's another 5 minutes. While you're waiting, we do need a favor. The Extel survey, formerly known as Institutional Investor, is open until June 27th. If you found this podcast helpful, we appreciate your support in the portfolio strategy category. Last year, we were honored to rank number 3 in a tight race, our first time in the top 3. We suspect our podcast listeners did a lot to help us get there, and we'd appreciate your support again. Now let's get into the details. We'll start with takeaway number 1. Solid earnings stats are in place as investors await the onset of 2Q reporting season. Even with everything that's been going on, we got several questions on our earnings outlook last week. Our latest checks suggest there's no reason to change our 258 S&P 500 EPS forecast for 2025. Meanwhile, we've been keeping an eye on our favorite gauge of earnings sentiment for the S&P, the rate of upward EPS estimate revisions, which fell to typical non-crisis lows for the index back in April and has now rebounded to 55%. That's a level that's not admittedly back to post-crisis highs, which actually seems fitting since this indicator never fell to crisis lows to begin with. But that 55% is a return to post-COVID highs. The recovery that's already happened makes us somewhat concerned. This stat is about as good as it's going to get for now. We also keep a close eye on where bottom-up consensus forecasts for the S&P 500 are relative to last summer. At the end of May 2025, the bottom-up consensus for full year 2025 S&P EPS was down 5% versus the level that was in place at the end of June 2024. That's a little less of a decline at this point in time than the median cut in years where forecasts start out too high. Importantly, in most years, the bottom-up consensus EPS forecast ends up being fairly stable in the second half of the year in question, reflecting the idea that companies push really hard in the second half to meet expectations, and before that, they work really hard to help establish those expectations. If negative revisions are coming for 2025, we think July and August are probably the time we're likely to get them. Moving on to takeaway number 2, corporate vibes have been weak. Late last week, the widely watched quarterly Business Roundtable survey was released and showed us a sizable drop in the CEO economic outlook relative to March. The survey was conducted in the first 2 weeks of June and also reflected a sizable drop in employment expectations and to a lesser degree CapEx. The economic outlook question came in slightly below the lows of late 2022 and 2023 and almost back down to the lows of late 2015. When risk-off sentiment has hit the stock market this year, we've tended to see more of a rising risk of a growth scare, a 14 to 20% type drawdown, as opposed to recession pricing, where the market tends to lose a quarter to a third of its value. And this data point on the survey lends support to that theory in our view. The weak C-suite vibes highlighted in the survey do echo the overall tepid tone that we sensed in last week's earnings calls. Uncertainty from geopolitics and other sources, consumer health, and tariff management and impact did remain in focus. One key recurring theme included strength in AI and data centers, along with the need to navigate with prudence and flexibility. Another theme, cost containment. We were surprised at how prominent this topic was, but discussion around this issue has been on the rise in recent months. We'll wrap up quickly with takeaway number 3, recapping our views on what the escalations in the Middle East mean for U.S. equities. It remains our belief that the longer and broader the conflict becomes, the more challenging it is likely to be for U.S. equities. These escalations come at a tricky time, as the S&P 500 has looked fairly valued or even a bit overvalued to us from a fundamental perspective, but it also looks like it may have more room to run from a sentiment perspective. The 3 main concerns that we've had are 1, the tendency for valuations to compress when uncertainty regarding national security rises, 2, the potential for the event to derail the recovery in investor, small business, and consumer sentiment that's been underway, and frankly to deepen the deterioration in corporate sentiment that's persisted, and 3, upside risk to oil prices. Lack of conviction that oil supply is at risk has in part kept stocks calm, but we think this thesis may soon be tested. Zooming out, the fog in the U.S. equity market outlook, which had dissipated a bit from a tariff perspective since mid-May, has gotten much denser in the past week due to geopolitics. In thinking about potential downside, we rely on our 4 tiers of fear framework for U.S. equity market drawdowns, which helped us navigate tariffs as conditions evolved in March and April. This framework reminds us that a 5 to 10% S&P 500 drawdown is a good starting point to assess potential downside risk when confronted with any major uncertainty, and we think that's a good starting point for thinking about downside risk today, especially since we've seen these kinds of reactions in stocks since 2023 to earlier episodes in the Middle East. If stocks sell off, it will be important to monitor the risk of a retest of the April 2025 low, which was a textbook Tier 2 growth scare, since our valuation stress test that takes inflation back to 4% points to possible downside in the S&P 500 to the 4,800-5,200 range, using various flavors of earnings. Besides an inflation spike, sentiment erosion could spark this kind of retest of the April lows if recession fears do start to percolate again. These risk scenarios would likely take some time to play out, however, allowing the stock market to be patient in how it trades for now. That's all for now. Thanks for listening, and don't forget to vote.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.